All right, so before I get too deep into the questions here, while people plumb in new questions, I want to talk about correlation, which we focused on in this morning's note, and some of the interesting things that I'm seeing there. So in this morning's note, you can see I talked about this correlation metric. I'm pushing TrendSpider to get the core charts. That's why I have this up today. So the TrendSpider, I really taken to TrendSpider. I like a lot of the stuff they have to offer. As you know, I've been doing a promotion. So I just happen to be looking at TradingView today because they have this core one chart. So you can see we hit June OPEX, even a little bit before June OPEX, and we just crushed in this metric, right? And if you zoom out, as I said again in the founder's note, we hit 2017 lows. And so I just want to talk about the significance of a lot of this. Many of you who have been subscribers with us for at least a couple of weeks, I know many of you have been around longer, thank you for that. But you know that I've been talking about this for a while and the impacts of it. And essentially what the correlation metric here measures is implied volatility or future volatility, we can call that, right, of 1 month options. So looking at the S&P implied vol versus the single stock implied vol in the top 50 constituents of the S&P 500 itself. So what this is saying is index vol is getting crushed, single stock vol is staying at or above, right? It's increasing relative. And so you get this declining correlation. And all of you who've been on my calls in the past know that if correlation moves to 1, it's telling you that all stocks are being bought or sold in unison, right? It's essentially, you could think of it as, instead of people worrying about what stock should I buy, NVIDIA is going to outperform Costco or whatever, it's we have to get the heck out of equities and into bonds because global pandemic, right? Or whatever it may be. And so you get correlation moves like that. And then when the pandemic is over or whatever it may be, we go, okay, we're all going to go back, rush into all equities, and then correlation means high for a little bit, and then eventually it comes down when people start picking stocks. So some people call low correlation the stock pickers market, but generally what it's speaking is it's a risk on, we all love stocks market. So in 2017, it was one of the sleepiest years in history, and that's what realized vol tells us, and somewhere in late 2017, we had realized vol on a 1 month basis hit 3.5-ish versus the 7.5 that we have today. So what does that mean? That means these $20 trading ranges that we have in the S&P, 50 bips max, 25 bips, that's kind of what we start to get. So volatility can get tighter than it is now, right? Going from roughly 50 bips a day down to 25 bips. And I've been kind of on record saying that, hey, these low correlation means that I think the VIX is going to start moving down to 10. And why is that? It's because if you look at 1 month realized volatility, it's 7.5. And the back of the napkin and math says that the VIX tends to trade 3.5 points above this. And there's a lot of caveats to that, but this is the back of the envelope kind of fair value estimates. You go, okay, well, VIX around 11, right, would be somewhere near fair value. We can oftentimes undershoot that fair value. So I say, hey, this is where I think the VIX should be. And correlation is only being reinforced to the downside now. Can it get much lower? Probably not. But does that mean it has to unwind? No. I mean, look at what happened here in 2017, right? It can stay not for a super long period of time, but we can maintain this. So for like another month, 2 months, it's possible. And as I talked recently about correlation unwinding, we looked at recently in the OPEX call, you can see this short relative spike. In April, we had the rate issue, right? People were worried about rates going up, and then we had the geopolitical situation. Those are two double whammies, and correlation suddenly started to break down a little bit, not a lot. S&P went down 5%, NVIDIA lost 20% over that same period, right? VIX got in the 15 to 20 area, but very quickly the dust settled and the correlation trade got hit even harder, meaning index vol really sunk after that, and then the single stock vols continue to go crazy, and so you can see we have new lows. So the issue in my view is we're likely not to get higher rates out of the next couple of months. Excuse me, sorry. Because of the elections. That's maybe it's a naive view, but I don't think Powell or Yellen or anyone's going to be like, unless it's like we are absolutely forced to do something about this, they're probably just going to say, hey, this is post-election problem, so it's party on summer. And if we don't get hit with some geopolitical or credit issue that can't wait until a post-election, can't wait for a post-election solution, okay, then that could bring up some problems. But betting on all hell breaking loose is generally not a profitable strategy, right? This is America. Stocks only go up is the general position of things. I know if you live in other parts of the world, it doesn't always work like that, but that's why you're all here on the U.S. markets, right? Hopefully some of you giggled at that. So what does that mean for us here trading today? It means that anytime that we get a little bit of vol, a little bit of pop and vol, I expect that vol to get crushed, sent back down. So if we spike a little bit like tomorrow because of a rebalance trade, then probably get that vol gets sold. And so, you know, you see also these staggered gamma support levels below. They're material and they suggest another interesting element of this trade, right? So when we're all sitting here, and this is the second part of this conversation, I just want to make sure it's clear. The takeaway from this is that dips, in my view, will get bought, spikes and vol will get sold, and a bear market rally of several weeks to a month is, in my view, not in the cards until, you know, maybe late August, early September kind of thing. Again, if a credit event happens and we break a vol trigger or something like that, then Brent will simply say, I was wrong, and this is the newly updated information, but this is my operating principle. Dips will be bought. All right, so the correlation trade, most of us understand that is traders are selling index vol and buying single stock vol, particularly, you know, the NVIDIAs and mainly NVIDIAs, a few other stocks. You know, like this name came up, right? And Micron had really pretty poor earnings, and you know, so there was a mild dip bought there, but this is higher volatility. This is what that means, right? Higher relative volatility. So, you know, some of these names are getting much more volatile than the single stock side of things. Excuse me, the index side, right? The index doesn't move. Everyone's been talking about that. But no, you know, record time without a 2% down move. Well, also record time without a 2% up move, right? All right. So that's one side of the equation, is that relative trade. The other relative side of that trade is the systematic call overriding strategies, which continue to gain in assets. JEPI is the most well-known of these. It's the largest. It has $33 billion in assets. There's a bunch of other of these QYLD, smaller single stock ones, as well as just people who are selling calls outside of systematic ETFs and strategies like this. Well, what is the net effect of these funds? Excuse me. They're selling calls. Dealers are buying calls. That means dealers have a big positive gamma position, which means that aside from the correlation trade, right, and the hedge funds doing that relative value trade of index vol to single stock vol, you have this supply of giant positive gamma that also serves to blanket the S&P and keep it from moving really much at all, right? So that compounds the problem. Also, you have stuff like, it's not as big, but NVIDIA 2X ETF, right? So there's a big long bias there outside of the correlation trade, but it reinforces that trade or reinforces those flows, right? So these assets continue to gain in size. The volume continues to gain in size, and that says nothing of 0DT. And I watch 0DT every day, like most of you do on here, and 0DT tends to buy the dip and sell the rip, and that just adds to all this. So the only way that this all changes, in my view, is a forced unwind of these positions, which would have to come with like a credit event or a big spike in interest rates or something that's like a margin call that moves the market, right, in a significant way. Because you can even go back to the March of last year where we had those banks fail, and you could argue like the S&P, yeah, it was down, but it wasn't like all hell broke loose, right? So how do you get the Volmageddon move? Volmageddon was a forced unwind of these VIX ETPs and the short vol complex just writ large, right? You know, what are some of the things that can happen that create that move, right? This is the move in February, because we finally just get built up with this short vol complex and people going, okay, this is a real nice vol spike, let's sell it, and then vol doesn't go down and it forces everybody out, right? It feels to me like a post-election thing where suddenly you can't punt off policy decisions or whatever else may be going on, right? And so that's the potential unwind. Now, related to that, I posed this question on Twitter because I've just been thinking about it a lot. When you look at a stock like NVIDIA, and I did a back of the envelope calculation, another back of the envelope calculation. There's a real theme with me on that. I'm not going to validate the numbers that are on this spreadsheet here, but I went through, I said, okay, free float in NVIDIA is roughly 3 trillion, right? That's the market cap. What roughly is indexed the S&P 500, XLK, NDX, et cetera. And so this number says on a rough basis, you got about a quarter to a third of, 25% ish, maybe based on just these ETFs. And I think this is conservative estimate of S&P value. So I'm going with the number 1/3 to 1/2 of the index free float, or excuse me, of NVIDIA free float is consumed by the indexing community, right? Pension funds, spiders, VOO, it's a huge Vanguard ETF. They're the Qs. And, this is the weighting of all these ETFs of NVIDIA. It's huge. Then you have people who just own the stock because they love the stock, right? In their 401k or big hedge funds, they're not day trading those shares. Those shares are not available to trade. So what is the tradable float of NVIDIA? I think it's a half maybe of what the advertised free float is. And so when you end up in a situation like this where you have huge options trading complex, NVIDIA is bigger than any single stock, at least it was last week, or ETF, right? The size of the call positions trading. And then there's a couple of other, Tesla and some of these other names. They're not as big as the indexing spot, but maybe Apple. Point is that the liquidity available for hedging of those underlying positions, of those options positions, has to be smaller, right? And I wonder how much available liquidity there is in NVIDIA really. Like, what is the real depth of book if it's gone down? Because these options flows are increasing, which should be a larger share of the, trading activity, which can exacerbate volatility. And that plays into correlation and things like that, because that vol, the realized vol of that single stock is going to go up if you have less liquidity, while as the index is just being supplied with unlimited amounts of positive gamma. And it just continues to exacerbate these dynamics. So again, the takeaway from this is that I think that the VIX is just going to continue to come down. It's a little bit higher. It's high right now. Okay, we got like a Powell speed bump next week and PCE tomorrow, but I don't think that stuff cares. It's 4th of July holiday. I just think we're going to be visiting. I think we're definitely going to break the post-COVID low, just visiting this 11.5. There's nothing definite, so I'm not allowed to say that, but I just feel like we're going to visit these lows in the coming summer months. All right. So hopefully that was helpful and helped to frame, what the current situation is. The other reason I bring this up is because if you read Twitter, it is, I don't know if it's just a change, and a lot of you maybe not on our Twitter, but it's just this thing of like all of these macro things, like, the consumer is dying and this is all going to hell in a handbasket. And like nobody cares. Today's straddle in front of the GDP print, these jobless claims, was 37 basis points. That's incredibly low and is below our one-day move, which takes me to one more point I want to make, and then I will take questions.